Hi, and welcome to Midas Investing. Today we're going to be taking a look at Canadian Pacific Kansas City Southern Railways, which trades under the ticker CP in both American and Canadian exchanges. This popular railway has gotten a lot of attention in the last couple of years, what with their acquisition of Kansas City Southern, which traded under the ticker KSU. The combined company has some of the most impressive assets in North America, in my opinion, what with them having the singular rail access into Mexico all the way from Canada. Not to mention, I'm generally bullish on the railway industry going forward. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So pulling open their first quarter earnings presentation, right here you can see a map of the railways that the company now holds, what with it stretching all the way into Canada, as I was saying, and all the way into the northeast of America, stretching down into the connection at Kansas City. And then the Kansas City southern portion of the company stretches down into the American South, into Texas, and then down into Mexico, all the way down to Mexico City, and even to Lazara Cardenas on the other side. So giving it multiple access points, both on the west and east coasts at northern and southern points. As they say here, they celebrated their official first day as a combined company on April 14th, and they're planning an investor day on the 27th and 28th of this year. So hopefully we can get some more forward information and also guidance from the company at that date. Just a brief comment on the performance that they had in the quarter. You can see here up 23% on a quarter from quarter of Q1 22 to 23. And with you can see the mixture of FX adjusted revenue as they have right here, about 37% of the revenue in that quarter coming from grain, 32% from automotive, followed by 23% metals, minerals, and consumer, and then 22% potash, and then a variety of other things. What's interesting about this upward movement of 23% is this doesn't actually take into account the acquisition itself, because these are the results for CP standalone, as it says down here in the bottom note. Things that are driving this growth in this last year or so is record breaking grain shipments, grain making up a huge portion of their business we talked about, and as well as export and domestic potash being a fertilizer for agriculture. So the combined two of those things you can see are all in the kind of the agricultural sector. There's been a huge upward movement in agricultural products, what with the Ukrainian conflict. And then there's also been softer demand in other portions of their business, such as coal volumes, as well as domestic demand of intermodal. Now, in mentioning the different types of the businesses that they operate in, I actually want to dive a little bit deep into this topic so that we can understand how I'm going to be building up my model for the combined company. As we can see here, they have their business separated into three main types: of bulk, merchandise, as well as intermodal. Intermodal, if people are not familiar, is a type of freight where you use the containers that can be taken off of trains and onto trucks and onto ships, and it can be the same container moved from one vehicle to the other with relatively simple mechanism for moving the actual container itself off of the vehicle. Versus bulk and merchandise, which have to be moved in and out of the actual truck or off of the freight car itself. And the reason why it's important to understand the difference between these is because intermodal has become a much more popular form of freight. However, it is much cheaper for the businesses that operate in it, which means it's also relatively lower margin comparatively speaking. So this drives a much larger portion of the volumes, but doesn't necessarily have the highest profit margins, because bulk and merchandise tend to be for more specialized aspects of their business. And now each of these sections of their business are separated into separate lines, as we kind of already talked about a little bit in the presentation, but I do want to dive further into that because we're going to have to compare the lines of business that Canadian Pacific has with Kansas City Southern's, because they have different ways of aligning the different portions of their business. And I had to find a way to combine the two in a way that would make it so that I could actually look at a longer run set of their numbers over ideally 10-year period rather than just a 2 to 3 year period. Which I mentioned a 2 to 3 year period because technically the company actually released a set of combined unaudited financials for the company that did give us some data based off of Canadian Pacific's already existing lines of businesses, as we were just talking about. You can see right here: grain, coal, potash, fertilizer, sulfur, the exact mix of segments named exactly the same ways, and they give us information for the year 2022, 2021, as well as 2020. So if you were going to build a model off of just the last 2 to 3 years, you could actually rely specifically on the metrics that the company gave you, which would give you certain efficiency-based metrics that are actually very useful to make a model off of, such as the gross ton mileage and the revenue ton mileage of the company, which takes fuel efficiency and track efficiency into account for the projections of your model. However, anybody who's watched my videos for any length of time knows that I like to rely on a much longer stretch of time. So unfortunately, I'm not going to rely on this combined set of numbers that the company actually gave us. And specifically what I mean is that, as we can see here, so the three sections that Canadian Pacific has, the bulk revenues, which is segmented off into grain, coal, potash, and fertilizer and sulfur. And then they also have the merchandise revenues, which is sectioned off into energy, chemicals, and plastics, forest products, metals, minerals, and consumer products, and as well as automotive. And then they have an intermodal segment that is split into domestic intermodal versus international intermodal. And likewise, if I come over to Kansas City Southern's most recent 10K and we look at the way that they segmentation off their revenues by business line, the only ways that I find them sectioning off in particular is by these particular lines right here: chemicals and petroleum, industrials and consumer products, agriculture and minerals, energy, intermodal, and automotive. And so, given the two sets of segments that the company gives me in ways that go back into a larger set of years, I actually chose to section off the revenues into this particular format right here. I chose to make Canadian Pacific's numbers align more closely with Kansas City Southern's numbers, because they actually had a larger spread of segments, which meant that I could combine two or three of them together in order to make them fit into these specific six segments. So coming over to our spreadsheet, we'll take a look at each of these individual product segments and then section it off into specific unit elements. Specifically in the bars, we have the total carloads for each of the individual companies, Canadian Pacific versus Kansas City, blue versus red. And then likewise, the line also shows the freight rate for this particular segment. So first we're looking at agriculture and minerals as a combined group. And as you can see, in general, Canadian Pacific has not only higher levels of carload total demand, but a much higher freight rate for this particular line of business. And again, this is a roughly equivalent segment. So for very similar product lines, we have a much higher freight rate. Coming over to the energy segment, we can see a somewhat similar and somewhat different picture at the same time. But with the carloads, we have higher levels of carloads for Canadian Pacific, but then that difference actually starts to even out as the decade moves forward, until they actually in 2022 have pretty close to the same level of total carload demand. However, the freight rate does have still a significant difference, with Canadian Pacific still having a much higher freight rate, though the gap is also closing here as well. Coming over to chemicals, petroleums, and plastics, we can see likewise similarly with a higher freight rate still for Canadian Pacific versus Kansas City in this particular segment. With the carload demand, not quite the same picture. We actually see Kansas City for the first several years had higher levels of carload demand, and then it started to even out, and then they've started to take the lead again. So interesting to see that it doesn't have to be that the higher level of demand also has the higher freight rates. There seems to be perhaps something particular about Kansas City versus Canadian Pacific. Taking a look at industry and consumer products, likewise, we still have higher freight rates for Canadian Pacific versus Kansas City, with still somewhat similar carload levels, somewhat higher for Kansas City for most of the years, but relatively close. And then coming over to automotive, we can see that the total car loads ebbs and flows a little bit, but on average, they seem to be roughly about the same, with the freight rates a bit closer for this segment, but still Canadian Pacific having higher rates than Kansas City. And then last but not least, we come over to intermodal, and we can see that this has the highest level of car loads versus any of the segments. As we kind of already saw, a large amount of business tries to go intermodal when it can, and they actually have relatively similar levels of carload demand for each of the companies. However, a much larger, much more drastic difference in the freight rate, which I found to be very, very interesting. Now, I've kind of already gone through all these segments before actually kind of like giving you the real hint. I've kind of buried the lead a little bit, but the truth is that there is specific reasons why Kansas City has lower freight rates comparative to Canadian Pacific. It actually comes down to the agreements that they have for land concessions with the Mexican government. They do have certain obligations to provide specific services at certain rates, with agreements for surcharges for the fuel being expended on their business line. This does mean that they're going to have lower freight rates in general for the privilege of having those land concessions and having the ability to operate that particular railway in that country. So you have to look at it as a little bit of a give and take. And we have to take this into account when we're making projections for the future, because we can't assume that the combined entity is just going to have the margins of Canadian Pacific just because they are the acquiring and surviving entity. So now with that backdrop, let's take a look at the relatively complex revenue model that I put together for the company. Up here in the top section, I have combined metrics for the company in general, the combined revenues, the combined cost of goods, operating expenses, as well as the percent of sales for each of those, and then the revenue growth over time, so just kind of get an idea of what is the combined entity financials look like. As I already said, the company technically provided 2 to 3 years worth of combined financials, but I wanted to do my own set of combined financials going back 10 years, so I chose to completely ignore their financials so that my method of combining would at least be consistent across the total 10 years. I also got an idea of what the total capital base looked like, so I could find out what their sales to capital ratio was, which incidentally, because of the way that they've accounted for the acquisition, technically the sales to capital ratio looks a lot lower in the most recent couple of years. And so I kind of wanted to see what would maybe be an idea of that, what it would look like once those accounting aspects finalize themselves out with the transaction. And so instead, I actually also got the sales versus PP&E, not just sales versus capital, which for a company that the vast majority of their assets are net PP&E, I figured this would be a reasonable compromise. And that actually does give me a pretty similar metric. So just to kind of summarize that as it is, revenue grew over the decade at about 2.2% compounded, relatively low comparative to the pretty high levels of revenue that we got over the last couple of years. A relatively low growth rate that compared to the revenue growth that we've gotten in the last couple of years, which is more in the high single digits. And so this is something that has to be taken into account, because I've also seen other valuations where people are taking the growth rates of the most recent 1 to 2 years and assuming that that's going to be the growth rate for the next decade. The combined company grew at 2% over the last decade. And if you look at the US railroad industry, as according to Aswath and Motoron's data set, the industry revenues for his particular data set actually didn't grow over the 9-year period. He doesn't actually have a full 10 years of that particular data set. And then I also wanted to compare the combined revenues to those US railway revenues, though it's worth noting that that's a US industry grouping, so it doesn't technically count Canadian companies. Either way, we can think of it as the ratio of those revenues to the ratio of the US revenues, which I would still think would maintain somewhat of a similar ratio. And so we can see that ratio over time. On average for these 9 years, it ends up being 17%. We're currently at 19 or 21% compared to the last 2 years. So we've already seen a growth in market share or relative market share compared to the US railway industry. The point I'm trying to make here is that we should be very moderate in our assumptions about growth for the company, because at the end of the day, these costs are transportation logistic costs that have to be borne by all the other companies in the economy. So their margins can really only go up so much without it implying an implicit decrease in margins for basically everybody else that uses their products. And I have a feeling that people who are making those valuations aren't using those consistent assumptions. I'm going to assume that while the combined entity is going to have some pricing power because of the monopoly that they hold in the particular assets that they hold, that doesn't necessarily give them an infinite ability to price outside of reason. Again, these railways also do operate at the express permission of the governments in which they operate, which includes not just the Mexican government, but also the US and Canadian governments. So anyway, moving past the combined entity financials as I have up here, I have the Canadian Pacific financials separated off right here, as well as their carloads on this line right here. The Kansas City numbers are below it, as well as the carloads below that. And then I have a section for each of those segment lines that we talked about. We have agriculture and mineral, then we have energy, then we have chemicals and plastics, then we have industrial and consumer products, then we have automotive, and then we have intermodal, as well as then we have other revenues, because this is primarily just the freight revenues, but other revenues for each of those companies make up anywhere from 2 to 4% of the company, and we're going to be relying basically on the longer term average of that for our projections. For each of these specific segment lines that we talked about, as I said, I'm sectioning it off into carloads and then freight rate for each individual one. And then we have each segment also by each company. So we're going to be taking a look at agriculture mineral for Canadian Pacific specifically, and then agricultural mineral for Kansas City specifically. The reason why I do it this way is so that I think that the actual combined revenues of the agricultural mineral, it's the companies in those industries are going to basically choose which portion of the railway that they're going to most ideally want to operate in, which means that if one section is likely to grow, perhaps another one will grow less fast or even shrink in total carload demands. How that affects the freight rates kind of depends on each of these segments. And then I'm tailoring each of these assumptions based off of kind of my own subjective views about each of these industries as well. So carloads for Canadian Pacific agriculture grew at like 30 basis points for the last 10 years. I'm going to assume that remains about the same. Freight rate grew at almost 2%. I'm going to assume that that remains about the same. Kansas City carloads grew at 2.4%. I'm assuming that remains the same. Freight rates 2.4%. I'm going to assume that remains the same. I'm generally relatively bullish on agriculture in general, so that's why I'm allowing the kind of assumptions of the last decade to remain similar for each of these. And I don't particularly see the agriculture of the Canadian portion of their business being affected by the agriculture of the Mexican portion of their business. People got to eat and people got to live where they got to live. Coming down to the energy segment of their business, the Canadian Pacific section shrank in carloads by almost 6% for the last decade per year. I'm going to assume that that happens at about half as much of a rate. Total energy demand, especially given the types of energy that this is being shipped here, I can see there's still being a decline in total carload volumes. However, it shrank at a much faster rate for the last decade, so I think that's got to slow down. The freight rate also dropped at over 3% per year throughout the last decade. While I do see potentially demand continuing to slow, I do think it's more likely that the rates themselves have likely bottomed, especially considering the total other quantitative factors in the economy that affect prices. So I think it's more likely that prices would stay flat in this particular scenario. Coming down to Kansas City, I see somewhat of a similar pattern in terms of the total carload levels. It shrank at negative 2% for the last decade. I see it maybe being flat for the next decade. And then likewise, the freight rates came down at just barely for the last decade, so I see it perhaps having a bit of a reversal over the next decade. Coming down to chemicals and plastics, they grew at 6.5% for the last decade in total carloads. I see it continuing to grow, considering this is an inherent input to a lot of industrial portions of the economy, but it probably is going to slow down in that total carload level, so I dropped it to 3%. Freight rates grew at almost 5%, considering this is still a relatively high demand portion for industries. I can see these freight rates continuing that high level moving forward. And then I'm actually relatively more bullish on the Kansas City sections of the economy, particularly the American South portions of their railways. And so I can see these carloads actually maintaining the high levels of demand into the next decade, and then similarly for the freight rates for them as well. Coming down to industry and consumer products for Kansas City and Canadian Pacific across this entire segment, this is another one where I'm basically just going to allow the steady state to stay as is. This works for me because I do see some of this as somewhat bullish, some of this as kind of moderate, especially given the carloads being at relatively zero levels of change versus relatively moderate decreases. And then the freight rates are also relatively moderate. I don't have as much specific subjective input for this one, so I just kind of allowed it to stay as is. Coming down to automotive shrank in carloads for Canadian Pacific at 3.5% per year. I see this also continuing to shrink, especially if some of the electric revolution does require us to have less cars than we have had historically. Then I can see that continuing to shrink, but perhaps at a slower rate, so I have it shrinking at half as much of a rate. However, there is likely to still be, I think, price levels of demand, especially if there is going to be a large amount of the volume of cars being changed over if they are electric vehicles. So I'm going to allow the prices to continue to rise at the same level that they did previously. And then likewise for Kansas City, I'm going to allow it kind of stay as it is for the car loads. It wasn't shrinking that fast, so I'm going to leave it at kind of the same rate. And then the freight rates, it was a negative 40 basis points. I flipped it around so that it kind of has a bit of a upward level to point at the higher levels of demand for the switchover in those cars. And then last but not least is intermodal, where perhaps I made some of the more interesting specific subjective choices about which price movements I think is more likely. Carloads for Canadian Pacific grew at 1.5% almost for the last decade. And the carloads for Kansas City shrank by 30 basis points or so for the last decade. I'm choosing to have them basically flip the positions from where they're currently at and have Canadian Pacific carloads stay basically where they are, and then have Kansas City grow at approximately the same rate the carloads did for the last decade of Canadian Pacific. And then likewise, freight rates, I am going to continue to have them rise for Canadian Pacific. It is only 1.5%, so I consider that a relatively low rise, and so I can see that continuing to stay pace. But I do see higher levels of demand in the American South, as I was saying. So with the higher levels of total intermodal demand in the South for this particular decade, I can see a high level of freight rate increase. So I actually chose to use double the freight rate increase of Canadian Pacific for the Kansas City for the next decade, so therefore 3%. So if we combine all of these growth rate assumptions for all of these individual segments together, we end up with approximately $13.2 billion in total revenue in 2032, which equates to approximately a 3% growth rate over the entire decade, which again, comparing that to 2.2% over the last decade, perhaps we would have moderately higher inflation over this next decade, and perhaps it's also just the decade for railways to be a little bit more profitable, so perhaps they can also just eke out a little bit higher revenue growth rate. I think 3% is pretty reasonable. I also chose to do a little bit of a sanity check with that industry total revenues, as we were talking about before. I chose to have those industries revenues grow at 2.25%, which is a current market set rate of inflation for the next decade. That gets us to 64 billion in 2032, and if we take our revenues as a percentage of that, we end up with 20.5% market share or comparative ratio, as I was talking about before. Now, I chose to also use this model to come up with an estimate for operating margins and free cash flow margins for the company, the combined company, based off of the differences in margins that existed within the companies previously, and then taking into account any changes that I assume is likely over the time frame. So specifically, we can see that the cost of goods as a percentage of sales, not the gross margin, but the cost of goods itself, is 47.5% over the last decade. But over the last 5 years, it's actually been more like 43.6%. So I chose to assume that they will likely continue to have those higher margins they've had over the last 5 years. And so as a percentage of sales, gross margins will be the inverse of that. And then total operating as a percentage of sales has been 11% over the last decade. I'm going to assume that for the Canadian Pacific portion of the business, that will remain approximately the same. The sales comparative to net PP&E, which is our proxy for the sales capital ratio, as I mentioned already, for the last decade was 0.4. I'm going to assume that remains about the same. And then coming down to Kansas City portion of the business, the cost of goods as a percentage of sales for them has been 52.5%. And I chose to actually leave their cost of goods as a percentage of sales the same as it's been for the last decade for them, partially because of those higher level of costs implicit within the concession rights, as I was kind of talking about a little bit earlier. And also you can see in general, it's a higher level of cost than Canadian Pacific has. And so I don't really want to assume that the combined entity is just going to have the best of both worlds across all metrics. I'm going to assume that there's going to be some sort of cost in there for having the combined entity. And that's going to be that the Kansas City portion of the business is just going to forever have lower margins in general. They themselves had a little bit of a better margin for the last 5 years, but I'm going to rely on that 10-year average as my proxy for it. Again, this is also the smaller half of the business, so I think it's reasonable to use this in the weighting. Now, the total operating cost as a percentage of sales was 11.8%, and this is one portion where I'm going to give the combined entity a little bit of a benefit of doubt. I'm going to allow instead the Kansas City portion, the operating costs, I'm going to allow it to be 11%, which was the same as the Canadian Pacific portion. So they are going to get that extra 0.8% for being a combined entity, effectively speaking. And then likewise, the net PP&E compared to sales was 0.33 for them, but I'm going to apply the Canadian Pacific capital efficiency ratio to them as well when making my assumptions about capital efficiency. So there's some portions where I'm going to assume Kansas City basically remains as the lower margin portion of the business, and then there's some portions of this where I'm going to allow the combined entity to take advantage of basically Canadian Pacific's better operating metrics and better performance in general, or better management, depending on how you want to frame it. And we can compare our projections for the combined company also against their various competitors over the historic time frame, not just Kansas City Southern versus Canadian Pacific. I do have both of them up here on this line as well, but we also have CSX, NSC, UNP, and CNI, several of the other major railroads. Up here on screen currently, we have gross profit margins. So as you can see, the blue line being CP, and then the red line being KSU. You can see, as we had already seen, much lower gross margins, but in general, you can see kind of where the spread of the rest of them are. So I think our general assumptions about where gross margins are going is really just in line with the total industry. And then likewise with EBIT margins, we see sort of the same picture, but I would also like to point out that in general, over the entire time frame, Canadian Pacific has generally been one of the top three in terms of EBIT margins within their industry. Currently number 2 compared to CNI in particular, though that probably has also some fuzziness with the restructuring charges going underway as well. So they might be able to surpass them moving forward. And then also return on assets, which is somewhat reflective of return on invested capital. We can see that in general, Canadian Pacific similarly also being in the top 3 for most of the time frame, except for the most recent 2-year period, which is when the kind of accounting for the merger takes place. So really this should start to bounce back once the two fully merge. Incidentally, the one place where Canadian Pacific doesn't shine quite so well, and actually it makes Kansas City look a little bit better, is in terms of the total liabilities as a percentage of assets, where you can see Kansas City had less than 50% as a percentage of total assets all the way up through around 2019 or so, where it started to raise a little bit compared to some of the competitors. And then likewise with the accounting changes due to the merger for Canadian Pacific, it's a little distorted for them in the most recent 2-year period. So coming over to our valuation spreadsheet, taking a look at the revenues, you can see as I have it right here, the expected case is at about 13.9 billion, which is a few hundred million higher than our revenue model gave us, but I'm kind of tilting it a little bit more optimistically. I am relatively bullish on this company with the upper bullish band going up to possibly 15.7, 15.8 billion, and the lower band coming down to possibly 11.4 billion, meaning case about 14 billion, and then the weightings kind of leaning downward into the 13ths. And likewise, we can come over to the operating margins portion of the spreadsheet, and you can see that the operating margins that I've kind of projected over the next 5 years are approximately 46%. Over the whole 10-year period ends up being about 47%, with it coming into a terminal period of about 44%, which is also still a hair higher than that assumption I came up with the model. Again, I'm just relatively bullish on this. I did also try to align my assumptions about operating incomes over the next few years relatively in line with the analyst assumptions, give or take a few differences in assumptions. And then if we scroll down, we can see how those operating margins look over the 10-year time frame, the operating income quartiles, as well as the operating income distribution, with the majority of cases kind of being around maybe 6 billion or so in the terminal year. And then coming over to the free cash flows and the capital investment portion, we can see how that also plays out with returns on invested capital for the next 5 years being around 9 to 10%, over the whole 10-year time frame being about 10.5%, and then ending at maybe around 11% in the terminal year. Free cash flows for the next 5 years averaging possibly something like 3.8 billion or so. Then for the next 5 years after that, maybe 5.5 billion, ending at around 5.5 billion. Returns on invested capital over time, you can see portrayed over here. Capital investments net of depreciation right here. So you can see for most part for the next few years, we're assuming depreciation amortization is basically the net of total capital investment needed. Then at some point, we're going to need a larger amount of capital investment again before we kind of move back into that steady state. Free cash flow distribution in the terminal year at about 5.5 billion or so. Coming over to take a look at other valuation assumptions, the terminal multiple that's implied by the discount rate and terminal growth assumptions I use gets us around kind of 18 to 20 as the weighted average of terminal multiple assumptions. And you can see the fair value displayed right here, with about 50% of outcomes being somewhere between about $63 per share and maybe $82 per share, median outcome at about $72 per share. And here you can see a simple DCF of the expected case valuation right here, with the current fair value around $73.50. It's currently at about the 77th percentile of the valuation distribution that I've created here, 11% to the downside, and expected returns over the next 10 years of about 6.8%. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So as you can see, Canadian Pacific Kansas City is one of the more interesting stocks to pay attention to. However, the market itself is paying close enough attention to it for it to be trading at a premium today. We'll definitely be keeping our eye on it, and would love to start a position on it if we can get it at lower prices. I'll catch you all in the next valuation. Bye.